How would it be if your investments could pay your bills each and every month? What if you could create a consistent paycheck from dividend stocks alone? In this video, I'm revealing a dividend portfolio of 7 stocks that will generate cash every single month. Even better, besides the dividends, the portfolio will continue to grow so your dividend payments increase every year. We're talking passive income dividends today on Let's Talk Money. Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Dividend investing has been hugely popular here on the channel. Why not? Who doesn't love getting those cash payments while you invest? In fact, another video on passive income dividends was the first to really blow up on Let's Talk Money, with over 265,000 people learning how to make their money work for them. But that video is more than a year old, so I wanted to update it, improve it by putting together a portfolio of dividend stocks that you can use for a reliable and consistent cash flow every single month. The problem with trying to pay your bills with dividends is that most stocks only pay 4 times a year, once every 3 months. There are some monthly dividend stocks, but they leave out the best opportunities in cash yield and return. So to solve this problem, I put together a list of dividend stocks so that you'll collect a solid dividend every month. These are some great blue chip dividend stocks, the most stable dividends you can find with high yields and a return that will grow your portfolio. I'll take you through each stock, why I like it, and how it fits with a monthly dividend portfolio. Make sure you watch for all 7 though, because it's really the entire portfolio that's going to create those consistent cash payments. First though, I want to reveal how I picked these stocks. Yeah, everyone on the Let's Talk Money community knows I'm not about just listing a bunch of stocks to buy. I want to give you the tools to find your own investments, a process you can use to be a better investor. So I first screened for stocks with a cash yield of 3% or higher, and I included any share buyback programs as well for that total cash return perspective. I then filtered this list for stocks with a history of growing their dividend. Now that's hugely important, and in fact, research has shown that companies increasing their dividend outperform the rest of the market by more than 7% a year. Then I looked for companies with a payout ratio that signaled a commitment to returning cash to shareholders, but not one so high that it limits future growth. This is also very important and something that we've talked about on the channel before. I love a good dividend, but a company paying out too much of its profits, so a high payout ratio, is just leaving itself at risk to lose market share and destroy the stock's value. So I want you to find companies in that sweet spot where the payout ratio makes for a good dividend yield, but not so high that it destroys the future value of the stock. Finally, I looked deep into the company's financial statements to do that fundamental analysis. Now, I'm looking here for higher profitability compared to peers in the same industry, strong cash flows, and a competitive advantage that really makes it a best-of-breed company. What I found was 7 bellwether stocks, companies that are icons of their industries with stable dividends and a history of strong returns. Now, Ford and the entire automotive sector has had a tough cold lately, but there's reason to believe the worst is over, and the shares pay a solid 6.3% dividend yield. The problem with the automakers is there was a huge rush on car sales after the recession. With that cash for clunkers program and interest rates near zero, the new car sales surged all the way to 2015 and have just sputtered since then. Ford management has done a decent job of cutting costs, but knows it has to do more. The company has gone from making cars on 27 platforms in 2007 to just 9 today, which gives it a lot more flexibility and efficiency. Ford has a solid year planned for product launches, including the Explorer and a new Super Duty truck later. We've already seen some good numbers from the launch of the Ranger, and sales should be good the rest of this year. Now, on that industry weakness, Ford hasn't increased its dividend since 2015, but it's got a solid history of making that cash payment. Dividends are paid in January, April, July, and October. The payout ratio is 78%. It is a little high, but still leaves room for growth. Earnings are expected 3.8% higher over the next 4 quarters to $1.35 per share, which puts the shares at extremely attractive 7.4 times price to earnings. Now, there's a good chance that Ford could surprise to the upside here. Earnings before interest and taxes, so that EBIT measure, jumped in the first quarter to $2.4 billion from just $1.5 billion last quarter. A lot of this was on a big move in profitability, from just 3.5% EBIT margin to 6.1%, which is a huge move for just 1 quarter. Now, of all the dividend stocks I cover, Realty Income, ticker O, is probably the most popular on its monthly payment and 3.9% yield. The real estate company is the largest triple net REIT in the U.S. with nearly 6,000 properties in 49 states and Puerto Rico. Most of the portfolio is in the retail space, which I don't love considering the evolution into e-commerce, but occupancy for Realty Income has never been below 96% in 23 years of business, so these are high-quality properties. The company has made 86 consecutive quarterly dividend increases, growing the dividend by 4.6% a year on average. Funds from operation have grown at a 5% annual pace with only one quarter falling FFO, which is pretty amazing when you consider that the rest of the REITs did during those 3 years to 2010. There are a few keys to the company's outperformance and some things that I'm watching for that to continue. The company runs on a sale-leaseback strategy, so it'll buy commercial properties owned by other companies and then rent the property back to them. So we're talking huge retail companies like Walgreens and Walmart. The company also runs a triple net model where the tenant pays all the property expenses. So Realty Income basically just collects checks and passes the profits on to investors. The company has almost zero exposure outside the US, but it's making a move on the European commercial property market. Whereas real estate firms own much of the market here in the United States, in Europe most of the market is still privately owned, so there's a big opportunity for a management firm to come in and consolidate. Now, Realty Income signed a $557 million deal recently to buy 12 properties from Sainsbury in the UK and then lease the property back to the company in 15-year terms. Rent growth jumped 1.5% in the first quarter versus an average of about 1% a year, so I think there's some really good chance that cash flow could surprise on the upside. Now, Realty Income put this graph out in the first quarter presentation to show how its shares have done on a total return and volatility basis, and I think it's a great chart with a lot to say. First is that you see Realty Income has produced a very strong annual return, over 15% a year for those 23 years, but that it's also done that with less violent ups and downs in the price. The graph is also an interesting look at how sectors and other stocks have performed over that period. So we see that some of these other solid dividend names like Johnson & Johnson, Verizon, and Procter & Gamble have produced decent annual returns with that lower volatility. These are your traditional safety stocks and consumer staples and telecom. On the other side here, you see some of these popular tech names that have been riskier, so more volatility, but have produced higher returns. Now, it would be hard to make a dividend portfolio that didn't include Coca-Cola, ticker symbol KO, with its 3.2% dividend yield and 55 years of dividend increases. Coca-Cola pays its dividend in March, June, September, and December, and has made that payment every quarter since 1920. Besides the dividend payment, Coke also has a share buyback program that returns a net $1.5 billion to investors for another 0.7% cash yield. Coca-Cola is number one in 32 of its top 40 markets and over 75 beverage categories. It's diversified across juice, dairy, water, tea, and coffee besides those soft drinks. This company sells over 1.9 billion drinks a day in 200 plus countries. So scale and distribution is really the story here and the advantage. The company has a brand and reach to create efficiencies that other companies just can't touch. Coca-Cola has been transitioning to an asset-light model over the last few years, selling off its bottling factories through franchise agreements. Now, this has really driven flexibility, with new products accounting for 17% of volume last year versus just 9% in 2015. So that product pipeline is extremely healthy. Now, as a result of this cost-cutting, operating profitability jumped to 30.8% last year from 26.9% in 2017, and management is expecting a further $600 million in savings this year. Now, earnings are only expected 1.4% higher over the next year to $2.13 a share, but management has a great history of beating expectations, so odds are this number is going to be a little bit higher. This next dividend stock in our portfolio is actually a fund, the Vanguard Dividend Appreciation ETF, or ticker VIG, with a 1.9% yield. Now, that yield isn't much, but I love adding this one for its total return. You can see it follows the market pretty closely, but it's outperformed by 5% over the last year and has produced a 14.4% annual return over the last decade. That price return is going to help grow your portfolio even as you're taking some of those dividends out. Now, the fund pays dividends in March, June, September, and December, and is a great addition to the portfolio for its diversification. If you just had 7 stocks, that's 14% of your money in each. Trouble at just one company could destroy your portfolio. The Vanguard Fund holds shares of 183 companies diversified across all 9 sectors of the economy. Now, that's going to go a long way to spread your risk around, and you've still got that huge growth upside. Now, we've got 3 more stocks to put in your dividend portfolio, but I want to get your opinion on this. What's your favorite dividend stock, and why do you think it should be part of the portfolio? Scroll down and let us know in the comments below. Verizon, ticker VZ, is the country's largest wireless carrier with 40% of the US market and pays a 4.4% dividend yield. The telecom giant pays dividends in January, April, July, and October with 12 consecutive years of increasing payments. The payout ratio is 61% of earnings, but that's typical for this industry. Now, earnings are expected just 0.6% higher over the next year to $4.74 a share, which sets it around 12 times on a price to earnings ratio. There are a lot of reasons to like this company though, and I don't think the market has priced in some of that upside. Verizon is leading in 5G tech developments with the world's first 5G ultra-wide network and 2 smartphones capable on the network. 5G is going to revolutionize mobile over the next few years, and Verizon is going to be there to take advantage of it. The company also has a lot of value in its new media group with the acquisition of AOL and Yahoo. Now it's inked a partnership with Google to distribute YouTube TV, which could be a huge deal for it. Verizon has bucked the race to the bottom price wars among the wireless carriers lately, which has hurt subscriber growth, but I like management's decision on this one. They might lose a few of the subscribers on that lower end, but I think they'll make up for it in profitability, and the share price will be rewarded by investors. Johnson & Johnson only pays a 2.7% dividend yield, but returned more than $5.8 billion to investors last year through a share buyback program for a total cash return of 4.3%. That conservatism, committing to a little lower dividend yield but offering that buyback, has helped the company increase the dividend for 57 consecutive years. Now, J&J pays its dividend in February, May, August, and November, with about 62% of profits going to cover the cash payment. The company is a runaway leader in healthcare, booking $82 billion in annual sales across pharmaceuticals, medical devices, and consumer products. Now, income from the pharmaceutical segment has taken a hit lately, but strength in consumer sales has filled the gap. Now, Johnson & Johnson has faced some uncertainty lately on the string of lawsuits around opioids, and they will likely have to pay a settlement. This is mostly factored into the stock, though, at this point, and large settlements typically are paid out over several years or decades, so I don't think the financial burden is quite as bad as the market sees right now. Earnings are expected 6.4% higher over the next year, which is extremely strong given the overall economic growth. That puts its shares around 15 times earnings, so not particularly expensive and some upside potential for higher return. Apple is our closet dividend stock with only a 1.76% yield, but a ginormous cash yield through the buyback program. To give you an idea here, Apple paid out about $13.7 billion in dividends last year. That was a healthy increase of 7.4% over its 2017 dividend, but still a fairly low yield. The company paid out another $72 billion, almost 9% of the market cap, to buy back its own shares, and still has over $66 billion in cash sitting on the balance sheet. Generating $64 billion in free cash flow each year, this is a company that has plenty to keep returning to shareholders. Apple makes its dividend payment in February, May, August, and November, and has then increased the dividend every year since it started paying again in 2012. Now, the company is slowly moving to a services-centered business model where hardware sales are less important and that recurring service revenue becomes a bigger share. The entire ecosystem of Apple products, from the phone, the tablet, and the Mac to all those services, makes it a consumer giant with an advantage over any other competitor. It basically means Apple only has to get you to buy one product or sign up for anywhere on its services, and it's a good bet that you'll be picking up other products and services. That's exactly the kind of thing you want to see in a company, and it makes for extremely stable cash flows. Earnings are expected higher by only 1.1% over the next year, but no company beats earnings like Apple. A beat of about 5% would put earnings at $12.62 a share and a price to earnings of 14 times. So here you see the entire portfolio, all 7 dividend stocks, their dividend yield, and the months you'll receive the payment. Notice we've got at least 3 payments coming in every single month, and the portfolio yield of 3.3% is about twice the average dividend yield on the stock market. I know a lot of you are asking, why not just invest in those highest dividend yielding stocks? There are stocks that pay 12 and 15% yields. Why not just invest in those? I do like some of those high yield stocks, and I've got a video on the channel ranking my top 5 for double-digit dividend yields. I'll leave a link in the video description to that one. What I wanted to do here, though, is create a portfolio for maximum stability and total returns. Now, these might not be the highest yields, but each stock offers a double-digit upside beyond that dividend yield. These are the stocks that you can count on to provide cash every single month when you need it, as well as growing your portfolio. So to give you an example of how well this portfolio works at producing monthly income, I've made this table showing the monthly payment that you'd receive on a $100,000 portfolio in these 7 stocks. You're collecting from $300 to almost $500 every single month, but what's even better is that you're going to see that portfolio value grow and your dividends grow over time. So that almost $4,500 in dividends you collect is just going to keep on growing every single year. I've got 3 more stocks you can add to this portfolio, 3 of my favorite stocks that pay monthly dividends. Click on the video to the right for those great monthly dividend stocks, and don't forget to tap that subscribe button to join the Let's Talk Money community.